So now what we are talking about is our illustration number 1 of unit 3rd of CA foundation study material, which is admission of a new partner. So in this illustration, this is a basic illustration in which it is given that this is the balance sheet as on date 1st of January 2022, and there are two partners in the partnership firm which who are Ram and Mohan. So their profit sharing ratio is given, which is 3:2, and on this date 1st January 2022 it is decided that Sham also will join the partnership firm, and the terms of the admission are given below, right? So this is the balance sheet. We will have a look at the figures. That's a building, plant and machinery, inventories, trade receivables and bank is given. So trade payables is on the liability side. Apart from this, we are having the capitals just, right? So guys, as on this date 1st January 2022, Sham is to be admitted to the partnership firm, and the existing partners have said to the Sham that you have to brought 25,000 rupees as your capital, and for goodwill also you have to bring 10,000 rupees, right? And in exchange of this, we will give you 1/5 share in our profits, right? Now sir, the new profit sharing ratio will become 5:3:2, and the assets have been revalued as under. So building, plant and machinery, inventories and trade receivables revalued figures is before you. So apart from this, the last adjustment says that it was found that there was a unrecorded liability of rupees 1500 for goods received but not recorded in books, and the requirement of the question is that pass the journal entries and also prepare the balance sheet of the firm after the Sham's admission. Okay, now in this video, now in this question, first of all, what we have to look at. So we have to look at that the partner, new partner, proposed partner is bringing up the 10,000 rupees as a share of goodwill, and we already know that this share of goodwill will be given to the existing partners in the ratio of their sacrifice, right? Whatever sacrifice they are making for the in the upcoming profits, right? So now let's find out the sacrificing ratio, right? So guys, sacrificing ratio find out karne ka, this is a very easy sacrificing ratio. This is very easy to find out sacrificing ratio. How we can find out? That's the existing ratio of Ram was 3/5, right? 3/5 was the existing ratio, and now the profits will be distributed in the ratio of 5/10, right? And if you do the maths, then this would be the LCM, right? And this and this, and the sacrificing ratio is 1/10, right? And what is the case with Mohan? Now let's find out. That's Mohan's existing ratio was 2/5, and his new ratio is 3/10. So again, the common LCM is 10, and this is 4, this is 3, and again this is 1/10, right? So as from here we can see that the sacrificing ratio is 1:1. That means equal sacrifice they are making. That means that 10,000 rupees will be given to Ram and Mohan in the equal proportion, which is 5,000 and 5,000, right? Okay. Now let's first of all do some workings. This question is basically about the revaluation account. We already know that we have to prepare the revaluation account whenever there is a case of admission, right? And in most cases we have to prepare this revaluation account. Now first of all, I am preparing the revaluation account in this case also. So what is the requirement of preparing this revaluation account? We prepare this revaluation account because now the existing partners affairs are being just allocating to them only, right? New partner will be a part of the firm after the existing affairs have been allotted to the existing partners, right? Okay. Now let's prepare the revaluation account, right? So I am making a rough workings of these, right? So first of all, we know that the Building is being revalued to 25,000. Existing value was 18,000. That means building account debit to revaluation account, and here I am writing that by building 7,000 rupees, right? So 7,000 is the amount. Now sir, what is the case with plant and machinery? Plant and machinery now is 12,000 and earlier were of 15,000. That means sir, revaluation account debit to plant and machinery, right? Right guys. So plant and machinery, and it is 3,000, right? Now it is given that the inventories is as it is, no change. But in case of receivables, earlier was of 10,000 and now of 9,500. That means guys, 500 is the reduction in the receivables, and that reduction is due to the provision for bad debt. I am writing down here to trade receivables, right? So to trade receivables I am writing down here 500, right? And there was an unrecorded liability also, so I am writing down here to unrecorded liability, right? So to unrecorded liability, or I can write down as to creditors or payables also, right? Because this amount is of purchases which is not recorded in the books of account, right? Now just see that sir, this is 7,000 and this is 3, 4,000 and 5,000, right? The credit side is higher by 2,000 and we have to write down the balance here, and that 2,000 will be given to the Ram and Mohan in their which ratio? So in their 3 is to 3, in their 3 is to 2, which is their existing ratio, right? So now let's find out that sir, this would be to Ram the amount would be 1200, right? And to Sham would be 800, right? Because 2000 divided by 5 is how much? 400, and multiply by 3 is 1200, and multiply by 2, right? Multiply by 2 is 800. So this is what we have allocated to them, right? Now guys, the total would be the equal at both the sides, which is 7,000 and 7,000 here also, right? Right. Now let's see, we have prepared the revaluation account. Now one working is remaining to be done by us now, which is related to the capital accounts. I am preparing the capital accounts also for the ease of understanding, right? Right guys. Now partners capital account I am preparing here, right? Right guys, then we will write down the answer part, right? So here I am writing down 3 columns. Here I am making 3 columns for Ram, Mohan and Sham at the debit side, and the same here on credit side also. This is for Sham, this is for Mohan, this is for Ram, right? Right guys, I am writing down here that's a Ram, Mohan and Sham, and here also RMS, which stands for Ram, Mohan and Sham, right? Right. Now let's see, so what all are the figures and the things which we have to write down here. This is our particulars part, this is our particulars, right? Right. Now let's see, first of all we will write down the balances, capital balances. So it is given that the balances of the capital by balance brought down. So guys, Ram was having a capital of how much guys? 20,000. Mohan was having a capital of 25,000. I am writing down here that's 20,000 and here is 25,000. Now sir, the Sham is fetching or Sham is Sham by bank, right? Bank account. So Sham is introducing 35,000, right? 25,000 for his capital and 10,000 for his goodwill share, right? Share in goodwill. Now let's see, that's let's distribute this goodwill amount to Mohan and Ram, right? Right guys, I am writing down here that's to Ram and Mohan account, to Ram and Mohan account, and the amount was 5,000 which we have already seen. So 10,000 here I can write down, right? Right guys. and here I can write down that's by Shyam's capital account. By Shyam's account, how much is the amount, guys? 5,000 and 5,000. We already know, right, sir? So now let's brought down the figure of revaluation account. So revaluation से हमारे को profit होगा था. So I am writing down here by revaluation account at the credit side of partners capital account, and the profit figure was of how much, guys? 1200 and 1200 and 800, right? Right, guys. Now let's see. Now I think that's all figures we given in the question we have noted down. Now let's do the total, right? Now let's do the total at both sides, right? So here is 20,000 plus 5,000, 25,000 and 26,200. So I can write down here that's a two balance carried down, and two balance carried down is how much? 26,000, right? 26,200. Here nothing is debited, so the credit total will be written down to be written down here as balance carried down, and the balances, this is 30,000, 30,800, so 30,800. Now the here total is 35,000 and here 10,000, that means 25,000. So this is our capital balances, right, guys. I am not writing down here the total because we already know what would be the figure to be written down here, right, guys. Now let's write down the journal entries, right, which the question is asked us to do, asked us to write down, right? So it is our debit side, it is our credit side. Now let's see, that's a debit and here is credit, and this is our note number, or sorry, folio number. So here I am writing down in this way, and this is our date column, which is not required, but though it is a standard format of journal, I am writing down, I have made the same format, right? So here is particulars column. Now let's see, that's the first of all what is happening, that's the cash is being brought down. So bank account debit by Shyam's capital account, right, sir, Shyam's account. Now sir, he is brought down amount of 35,000. Narration we can write that sir, being capital introduced, and goodwill amount brought in, right? This is the first entry. Now let's distribute this goodwill account, right? So Shyam's capital account we will debit, Shyam's capital account debit. We have to credit this amount to Ram's capital account, right, and to Mohan's capital account. So I am writing down here to Mohan's capital account. Now what is the amount of goodwill? 10,000 rupees. Here we have to write 5,000. Again here we have to write 5,000. Narration we can write that's being goodwill amount distributed, goodwill amount distributed to existing partners or to sacrificing partners, right? In this case both the partners are sacrificing, so therefore both the partners have been given the amount. Now let's see the next journal entry. Now we can write down the revaluation related entries, revaluation account related entries, right, guys. Now revaluation we have debited, and what accounts we have credited, guys? So revaluation account debit. So which accounts we have credited? So we have credited the account of plant and machinery, trade receivables, and the payables account, which was our unrecorded liability, right, guys. So plant and machinery receivables to P&M plant and machinery, 2 trade receivables, right guys, and 2 payables लिख सकते हैं, we can write down payables here, right, so 2 trade payables, but that though was an unrecorded liability, we can create unrecorded liability also, but 2 trade payables, this is better. So 2 trade payables. Now in P&M we have to write down 3000, in receivables we are creating 500, and in payables we are creating 1500, right? So this is 5000, right guys. Now we have to just here we have to write down being assets revalued, guys. Now revaluation account we have to credit, and building account we have to debit, so building account debit. And apart from this, what else we have debited? Just building we have debited now, so building account debited to revaluation account, so 7000, right guys, 7000. Here I am writing down that's being assets revalued, so being assets revalued, definitely. Okay, now what else is remaining, guys? What else is remaining? Journal goodwill entries we have written down, right guys. Now I am thinking that we have written down all the journal entries. Now let's prepare the balance sheet, then we will look at that whether we have missed any journal entry or not, right? So here I am writing down the balance sheet of the firm as at 1st of January, right? That was 1st of January now, that date was, what was that date? 1st of January 2022. So now let's write down that date, 1st of January 2022. We are preparing the balance sheet, so here is the balance sheet structure, right guys. This is our asset side, this is that was our liabilities side, and whatever assets and liabilities we have to write down here. So guys, that building was 25,000, right? And that plant and machinery was of how much? The revalued figure was how much? So I guess 12,000, right guys. So 12,000 is the figure of this P&M, and we are having inventories also of 12,000, and we are having receivables, but of these receivables of 10,500 is bad debt, so we can create bad debt account, provision for bad debt. This is our 9,500 less provision, right guys. Now we are having the bank account. So bank balance is how much? Existing balance was of how much? Existing balance was of 5,000, and 35,000 has been brought down by the new partner. So now the latest balance is 40,000. This is our asset side. Now let's come to the liability side, payables. So payables is of how much? So payables earlier balance was 15,000, right? And unrecorded we have got plus unrecorded. So unrecorded is how much? 1500, right? So now 16,500 is this balance. Apart from this, now we are having the capital accounts to write down. We are writing down the capital balances. So capital balance of Ram is how much, Mohan is how much, Sham is how much. We already have done the working. We already know that 26,200 is the balance of Ram, and 30,800 is the balance of Mohan, and this is having a balance of 25,000, which is Sham. So I have written down here the balance. Now let's see that's whether they both are telling or not. If they are telling, then we have arrived at the right answer, then not, otherwise not. So 16,500 plus 26,000, 16,500 plus 26,200 plus 30,800 plus 25,000. This is giving us 98,500. Now let's do the total of here also. So 25 and 12 is 37, 37 and this is 47, 47 and 2 is 49, 49 and 9 is 58, 58, right, and this is 98, 98,500 and this is also 98,500. So here we have arrived at the right figure because both the sides are telling. So I think that's now the answer is clear to you all. I hope you are having no confusion in your minds now. Thank you.